Most traders think the secret is finding the right stock. They spend their days hunting symbols, chasing news, studying patterns, waiting for that one perfect setup that will finally change everything. But what if the real difference between a reckless trader and a disciplined one is not what he buys, but what he refuses to risk? What if $20 could teach you more about trading than 20,000 ever could? That sounds backward, doesn't it? And yet, that is where real understanding begins. Because markets have a strange way of exposing a man. Give him too much size, and his emotions speak louder than his judgment. Give him just enough exposure to feel the market, but not enough to fear it, and suddenly, he can see clearly. That is the purpose of the 20-year position rule, not the amount itself, the principle behind it. You see, when your position is so small that a loss feels almost meaningless, $20, perhaps, you stop acting like prey. You stop flinching at every tick. You stop worshipping every candle on the screen. And when fear leaves the room, observation enters. Have you noticed how different the market looks when you're calm? The pullbacks seem ordinary instead of terrifying. The breakouts look either genuine or weak instead of looking like urgent opportunities you must chase. Volume tells a clearer story. Price movement starts speaking in rhythm instead of noise. Why? Because your money is no longer shouting over the facts. That is the first lesson. Small exposure creates clean observation, and clean observation creates better judgment. Most traders reverse this process. They enter large, then try to think clearly under pressure. But pressure narrows the mind. It shortens vision. It turns analysis into reaction. A small loss becomes unbearable. A small gain becomes something to protect. Every move becomes personal. Then what happens? They cut winners too quickly because profit feels fragile. They hold losers too long because loss feels painful. They average down because ego demands rescue. They revenge trade because frustration wants revenge. And slowly, without realizing it, they stop trading the market and start trading their emotions. Have you ever watched yourself do that? Knowing exactly what you should do while doing the opposite. That gap between knowledge and action is where accounts disappear. The 20 position rule closes that gap. It teaches emotional obedience. You take a position so small that you can actually follow your rules. You place the stop where it belongs, not where your fear is comfortable. You let the trade breathe because you are not choking it with anxiety. You wait for confirmation because urgency has lost its grip, and something subtle begins to happen. Patterns repeat. Behavior becomes familiar. You start noticing things that cannot be learned from books. You notice how strong stocks resist bad news. You notice how weak stocks struggle even on good news. You notice false breakouts have a certain hesitation, a brief lift, weak follow-through, then quiet selling pressure. You notice true strength rarely asks permission. It moves with conviction. These are not indicators. These are observations, and observation is what builds instinct. But here is where most people miss the deeper lesson. The 20 position rule is not only about protecting capital. It is about building trust in your own process. Because if you cannot manage a tiny position properly, what makes you think you will manage a large one wisely? More money does not improve discipline. It magnifies character. If you panic small, you will panic big. If you hesitate small, you will hesitate big. If you break rules small, you will destroy rules big. Size doesn't create weakness. It reveals it. So the wise trader starts where weakness can be studied cheaply. He treats small trades like serious trades. He records entries. He records exits. He asks why here? Why now? Why this level? What was volume doing? What was the broader market doing? Was I early? Or was I impatient? Simple questions. Honest questions. Questions most traders avoid because honest answers are uncomfortable. And yet, the discomfort is valuable. Would you rather pay $20 for a lesson? Or 20,000? The market will teach either way. Your choice is simply the tuition. Now let us make this practical. Suppose you see a breakout forming. Volume rises. Price tightens. The setup looks attractive. Your instinct says, go big. The 20 position rule says, test first. Take the small position. Watch what happens after entry. Does price hold above breakout level? Does volume remain supportive? Do sellers quickly appear? Does momentum continue or stall? This is live information. Real information. Information that charts alone cannot fully reveal. Then, and only then, if the market confirms your thesis, you increase exposure. Notice the sequence. Probe, observe, expand. Not expand first and pray later. That single shift changes everything. Now you're no longer gambling on opinion. You're building on evidence. Cause and effect. Evidence creates conviction. Conviction creates patience. Patience creates selectivity. Selectivity improves performance. And improved performance strengthens confidence. Not blind confidence, but earned confidence. There is a difference. Blind confidence says, I know. Earned confidence says, I've seen this before. One is ego, the other is experience. Which one do you think survives market storms? And what about losses? Here again the rule teaches wisdom. A small losing position reveals whether your idea was wrong without damaging your capital or your mind. That matters. Because heavy losses do more than shrink accounts. They distort thinking. After a hard hit, traders become timid at the wrong moment and aggressive at the wrong moment. Their judgment becomes haunted by the last mistake. But a controlled loss that keeps the mind clear. Clear minds make sharp decisions. Sharp decisions compound. This is how professionals think, not in terms of excitement, but in terms of positioning, probability, and preservation. Calm, deliberate, detached, not passive but controlled. There is strength in restraint. There is power in waiting. And there is enormous advantage in learning how the market behaves when your emotions are quiet enough to hear it. So ask yourself, when you enter a trade, are you studying the market or merely reacting to your own feelings? Are you building skill or feeding impulse? Are you risking money to make money or risking small money to understand money? That distinction seems small. It is not small. It is the line between noise and clarity, between compulsion and discipline, between a trader who is forever chasing movement and one who begins to understand the quiet mechanics underneath price itself. Most traders believe bigger positions create bigger opportunity. That belief sounds logical. More size means more profit, more excitement, more reward. But the market has a habit of punishing what seems obvious. The moment a position becomes large enough to matter deeply, clarity begins to disappear. Thought becomes clouded. Judgment becomes emotional. A trader who was patient before entry suddenly becomes restless after entry. Why? Because size changes perception. When too much money is on the line, every price movement feels important. A small pullback feels dangerous. A normal pause feels like weakness. A minor fluctuation begins to look like a warning sign. The mind stops reading behavior objectively and starts translating everything through fear, hope, and urgency. And once emotion enters, vision narrows. You stop seeing the broader structure. You stop noticing how price reacts around key levels. You stop reading volume with patience. Instead, your attention locks onto profit and loss, tick by tick, candle by candle, reacting instead of observing. But reduce the size, make it small enough that the outcome does not disturb your thinking. And something changes immediately. You begin to see clearly. Now price becomes information instead of threat. Pullbacks can be studied rather than feared. Consolidation can be understood rather than misread. You notice whether buyers defend levels with confidence or whether strength fades the moment resistance appears. You start reading behavior instead of reacting to movement. This is where sharp vision is built. Not in pressure, but in calm observation. A small position creates emotional distance, and emotional distance creates accuracy. You become less eager to force meaning into random movement. You become more willing to wait, to watch, to let the market reveal its hand before making assumptions. Have you noticed how often impatience comes from discomfort? The urge to act, the urge to close, the urge to adjust. Most of it is emotional noise created by exposure that feels too heavy. When risk is light, that noise fades. What remains is cleaner judgment, and cleaner judgment compounds. You begin recognizing the difference between true strength and temporary excitement. A strong move holds its gains. It absorbs selling pressure. It advances with purpose. Weak moves surge quickly, then hesitate, then fade when buying interest disappears. These distinctions are easy to miss when fear is loud, but obvious when the mind is quiet. That is the hidden advantage of small size. It sharpens observation, and sharp observation builds instinct. Not instinct based on guessing, but instinct built from repeated, clear seeing. Over time, patterns become familiar. Behavior becomes readable. You stop feeling surprised by market action because you have trained yourself to watch without emotional distortion. Then confidence starts changing form. It is no longer reckless confidence built on excitement. It becomes calm confidence built on understanding. You trust what you see because you have learned how to see it clearly. This is where many traders misunderstand growth. They think scaling up creates skill. In truth, skill is built small, then carried upward. First vision becomes sharp, then discipline becomes consistent, then execution becomes precise. Only after that should size increase, because larger positions magnify everything already inside you. If your observation is weak, size makes it weaker. If your discipline is unstable, size makes it unstable. But if your vision is sharp, if you can read price with patience, interpret behavior without panic, and act with control, then size becomes a tool rather than a burden. Small size teaches that skill. Sharp vision comes from that lesson. Most traders enter the market carrying weight they cannot handle. Not just financial weight, mental weight. The pressure to be right. The urgency to make money quickly. The need to recover losses. The fear of missing a move. All of it creates heaviness, and heavy minds do not read markets well. They rush. They force decisions. They confuse movement with opportunity. Then they wonder why the market keeps humbling them. Have you ever noticed how clearly you can analyze a chart before entering a trade, but the moment you're in, everything changes? Suddenly every candle feels personal. Every pullback looks threatening. Every small gain feels like something that must be protected. The market itself has not changed, but your relationship to it has. Exposure has turned observation into emotion. That is why a trader must learn to trade light. Light size creates room to think. When your position is small enough that a temporary move against you does not disturb your judgment, your mind stays open. You can still study price objectively. You can still ask honest questions. Is support holding? Is volume confirming? Is momentum expanding or fading? Is strength real? Or only appearing strong because of short-term excitement? These are important questions. But under pressure, most traders stop asking them. They become reactive instead of reflective. Trading light changes that. You stop entering positions as if every trade must be a major victory. You start treating trades like information. A position becomes a way to test an idea, not prove your worth. That subtle shift changes how you behave. You become more patient with entries, more disciplined with exits, more willing to admit when the market is showing something different than what you expected. And because your ego is less involved, your eyes become sharper. You begin reading deeply. You notice whether breakouts hold or quickly lose energy. You notice whether pullbacks are healthy pauses or early signs of weakness. You watch how price behaves around important levels, not just whether it touches them, but how it reacts there. Does it reject quickly? Stall quietly? Push through with force? Struggle and retreat? Behavior tells the story long before headlines do, but only calm minds can hear it. Most traders are too loud internally to notice. Their thoughts are crowded with profit targets, fear, and second guessing. Their eyes are on money instead of behavior. And when money becomes the focus, reading the market becomes difficult because attention is pulled away from what matters most. Price action is language. Volume is emphasis. Timing is tone. When you trade light, you can listen. And when you listen deeply, patterns begin revealing themselves. Not obvious patterns everyone talks about, but quieter truths. How strong assets absorb pressure without panic, how weak assets rally with hesitation, how false strength often needs attention while real strength moves with quiet confidence. That kind of understanding cannot be rushed. It must be observed, repeatedly, carefully. This is where skill is actually built, not by swinging hard, but by watching closely. Not by forcing gains, but by developing judgment. The trader who learns to read deeply gains something more valuable than a single profitable trade. He gains perspective. He becomes less emotional, less impulsive, less easily fooled by noise. And with that comes control. Trade light enough to stay clear, and read deep enough to see what others miss. Most traders fear losing money, but very few understand the real value of a small loss. They treat every losing trade like failure. They resist it, deny it, fight it, and often make it larger simply because they cannot accept what the market is telling them. That reaction is expensive, not only financially, but mentally. A heavy loss damages confidence, clouds judgment, and quietly pushes a trader into emotional decisions that create even greater mistakes. But a small loss can be one of the cheapest and most honest teachers in the market. Have you ever entered a trade with strong conviction, only to realize within minutes that something felt wrong? Price failed to follow through. Volume lost strength. Momentum faded. The setup that looked promising suddenly looked weak. In that moment, the market is giving feedback. Clear, direct, useful feedback. The question is, can you hear it without your ego interfering? When risk is small, you can. That is the hidden power of tiny exposure. Small risk creates honest feedback. Because when little is at stake, truth becomes easier to accept. You do not feel the desperate need to defend your position. You do not invent reasons to stay in a bad trade. You do not search for hope where there is no evidence. You simply observe what is happening and respond accordingly. That keeps your judgment clean, and clean judgment is everything in trading. A small loss tells you where your reading was wrong. Maybe your timing was early. Maybe resistance was stronger than expected. Maybe the broader market was weakening while you focused only on one setup. Maybe what looked like accumulation was actually distribution. These are valuable observations, but only if your mind stays calm enough to study them. Large losses make study difficult. Pain overwhelms curiosity. Regret replaces reflection. Emotion drowns out insight. That is why expensive mistakes often teach less than cheap ones. They create too much internal noise. The trader becomes consumed by damage control instead of learning what actually happened. Cheap losses are different. They leave room to think. They allow a trader to step back and ask useful questions. What did I miss? What warning sign appeared early? Was volume confirming, or was I assuming strength? Did I follow evidence, or did I follow excitement? These questions sharpen skill because they turn mistakes into information. And information, used correctly, becomes an edge. Most traders pay heavily for lessons they could have learned cheaply. Not because the market demanded it, but because pride demanded it. They hold when they should exit, add when they should reduce, hope when they should observe. All because admitting a small mistake feels uncomfortable. Yet that refusal creates a much larger problem. The wise trader understands something simple: a small loss is not punishment. It is feedback, quick feedback, honest feedback, actionable feedback. He takes the lesson while it is cheap, then he moves on with clarity intact. This creates a powerful habit. Over time, losses stop becoming emotional wounds and start becoming useful signals. They become part of the reading process. A failed trade is no longer seen as defeat, but as information about market conditions, timing, or behavior. That mindset removes fear because loss is no longer something to avoid at all costs. It becomes something to understand. And that changes everything, because once fear of being wrong weakens, observation becomes stronger. Execution becomes cleaner. Patience improves. Confidence becomes steadier, built not on winning every trade, but on trusting your ability to manage truth when the market reveals it. Tiny risk keeps the lesson honest, and keeps the trader honest too. Most traders believe the market is confusing because price moves too fast. That is only half true. The market often looks confusing because fear is speaking louder than reason. A trader watches candles, volume, breakouts, reversals, but beneath all that observation is a restless mind translating every movement into personal consequence. A red candle becomes danger. A pullback becomes doubt. A delayed breakout becomes frustration. The chart is no longer being read for what it is. It is being interpreted through emotion, and emotion is a poor translator. Have you ever noticed how different a chart looks when you have no position in it? You see structure clearly. Resistance levels stand out. Volume behavior makes sense. You can recognize hesitation, strength, weakness, and momentum without struggle. Your thinking is calm. Your judgment is sharp. Everything appears simple. Then you enter. Suddenly the same chart feels uncertain. What changed? Not the market. You changed. Fear entered quietly. Fear of losing. Fear of missing out. Fear of being wrong. fear of giving back profit. These fears may not always feel intense, but they shape perception in subtle ways. They distort what you see. They create urgency where patience is needed. They create hesitation where decisiveness is required. They make random movement feel meaningful and meaningful movement easy to ignore. That is why fear is so dangerous. It does not always shout. Sometimes it whispers and quietly bends your judgment. When fear is active, traders stop observing behavior and start reacting to sensation. They stare at profit and loss more than price action. They focus on what they feel instead of what the market is showing. This creates impulsive exits, forced entries, and constant second guessing. The mind becomes noisy, and noisy minds miss quiet truth. Markets reveal themselves through behavior, through how price reacts at levels, how volume expands or contracts, how momentum follows through or fades. Strength often appears in subtle persistence. Weakness often appears in hesitation before decline. But these signals require attention, and attention becomes difficult when fear dominates the mind. Fear narrows vision. A calm mind expands it. That is where real understanding begins. When fear becomes quiet, through smaller size, clear risk, patience, and disciplined thinking, the market starts speaking more clearly. You notice things you once missed. You see whether buyers are defending price or merely reacting temporarily. You recognize when a breakout is built on conviction and when it is built on excitement. You see when selling pressure is aggressive and when it is simply normal movement within a healthy trend. This kind of reading cannot happen in emotional chaos. It requires internal stillness. Most traders search for better indicators, better systems, better setups, when what they really need is a quieter mind, because the problem is often not what they are looking at, but how they are looking at it. Fear creates distortion. Clarity removes distortion. And once distortion fades, price begins to make sense in a deeper way. Not because the market becomes easier, but because your perception becomes cleaner. You stop forcing meaning into noise. You stop chasing movement that lacks substance. You stop making decisions from discomfort. Then patience strengthens. Observation deepens. Judgment sharpens. And slowly, almost quietly, you begin hearing what the market was saying all along. When fear grows quiet, truth becomes easier to see. Most traders commit too early. They see movement, feel excitement, and instantly decide they have found opportunity. The position goes on at full size, conviction rises before evidence appears, and from that moment forward, the trader is emotionally attached to an idea that has not yet proven itself. What follows is usually familiar: hope when price hesitates, anxiety when it pulls back, stubbornness when it weakens. All because commitment came before confirmation. That is backward. A wise trader learns to probe first. Have you ever watched a setup look perfect before entry, only to behave completely differently once the trade begins? A breakout stalls. A reversal loses momentum. Support breaks too easily. Volume fades where strength should expand. The idea looked right, but behavior told a different story. This is why first entry should never be treated like final commitment. It should be treated like a question asked to the market. A probe is that question. A small position, placed with purpose, allows you to test your read without exposing yourself heavily. It is not hesitation. It is intelligent observation. It is stepping into the market lightly enough to gather information, but deliberately enough to feel the truth of price action in real time. Because markets reveal more after entry than before entry, charts can suggest. Patterns can hint. Volume can imply. But actual behavior after participation confirms. That confirmation matters. A true breakout should hold levels with confidence. It should attract follow-through, not immediate selling pressure. Strong momentum should continue with purpose, not struggle after the first push. If support is real, buyers should defend it with conviction, not weak reaction. These are signs that your idea has substance. But if price hesitates where strength should appear, if volume disappears, if momentum feels forced, the market is answering your question clearly. The probe has done its job, and because size was small, the answer came cheaply. That is important. Most traders make large commitments based on expectation, then suffer large consequences when reality disagrees. They enter with certainty before evidence exists. When the market turns against them, they become trapped, not only financially, but psychologically. Large size creates emotional attachment. Emotional attachment creates blindness. The trader stops reading what is happening and starts defending what he hoped would happen. A probe prevents that. It keeps the mind flexible. It allows observation to remain honest. You are not married to the trade. You are studying it. You are watching how price responds, how volume behaves, how momentum develops, whether pressure builds or weakens. You are allowing the market to prove itself before trusting it with larger exposure. This changes the whole rhythm of trading. Patience replaces urgency. Evidence replaces assumption. Calm replaces force. Then commitment becomes intelligent. When the market confirms your thesis, when strength follows strength, when weakness deepens as expected, when behavior aligns with your rid, you increase size with greater confidence because now your decision rests on proof, not hope. Notice the difference. You are no longer betting big on possibility. You are building bigger on confirmation. That sequence protects capital, but more than that, it sharpens judgment. Over time, you begin recognizing what healthy confirmation looks like. You see whether momentum is genuine or shallow. You notice whether buyers are committed or simply reacting. You feel the difference between real strength and temporary noise. And that awareness becomes skill. The best traders do not rush commitment. They test first, then trust what proves itself. Most traders think discipline appears when money becomes serious. They tell themselves, when I have a larger account, I'll become more careful. When the stakes are higher, I'll follow my rules. When real opportunity comes, I'll trade with patience and control. But the market does not work that way. Discipline does not suddenly appear under pressure. Pressure exposes what is already there. Have you ever promised yourself you would respect your stop loss, only to move it when price got close? Have you ever planned to wait for confirmation, only to chase a move because it looked like it was leaving without you? Have you ever sworn you would avoid revenge trading, then placed another trade simply because frustration demanded action? Those moments reveal something important. Discipline is not what you intend to do. It is what you repeatedly do when emotion is involved. And that habit is built small. This is why small positions matter far more than most traders realize. When risk is limited, your mind stays clear enough to practice proper behavior. You can place your stop where logic says it belongs and leave it there. You can let a winning trade develop without grabbing at profit too early. You can sit patiently when there is no setup instead of forcing action out of boredom or impatience. In small size, obedience becomes possible, and repeated obedience becomes discipline. That is how discipline is built, not through motivation, not through strong words, not through temporary determination, but through repeated controlled action under real market conditions. Small positions create the training ground. They allow you to rehearse good behavior without emotional overload. Every correct action strengthens a pattern. Every time you respect your risk, you reinforce restraint. Every time you avoid chasing, you strengthen patience. Every time you accept a small loss cleanly, you weaken ego's grip on decision-making. Slowly, behavior changes, and behavior is what matters. Most traders focus on outcomes too early. They judge themselves by profit and loss instead of process. A reckless trade that makes money feels like success. A disciplined trade that loses feels like failure. That thinking is dangerous because it rewards bad habits and discourages good ones. The market can pay you for poor behavior in the short term. That does not make the behavior wise. Real discipline means judging yourself by execution, not immediate outcome. Did you follow your plan? Did you wait for evidence? Did you manage risk properly? Did you stay emotionally steady? Those are the right questions, and small positions make honest answers easier. Large positions make honesty difficult because ego becomes deeply involved. Once meaningful money is at risk, pride wants to be right, fear wants comfort, greed wants more, patience weakens, rules start bending, justifications appear. A trader who looked disciplined in theory begins acting impulsively in reality, not because he lacks knowledge, because he lacks practiced control. Control must be trained before size grows. A musician practices slowly before performing fast. A fighter masters technique before stepping into a hard fight. A craftsman learns precision before handling complex work. Trading is no different. Discipline is a skill, and skills are built through repetition at manageable levels, not under crushing pressure. That is why the small trade matters. It is where habits are formed. It is where patience is strengthened. It is where emotional reactions are studied and controlled.